Welcome back to the CPA Revolution. I'm Sharina Padilla here with our tax strategy expert and co host, certified tax coach and CPA, Jose Ortiz. If you are tired of traditional reactive CPA advice and want to turn taxes into a wealth building tool, you are in the right place. Hi, Jose. How are you doing today?
Hey, what's going on? Just finished another tax deadline.
Yeah, 9:15 was definitely rough, and the influx of projects that we've been dealing with since July, it's just what makes you feel like you're actually making a difference, right?
Right, very
Um,
needed.
yeah, the only thing that I don't like is those clients that wait till the last minute and then wonder why their projects didn't get completed. So I wish I can inspire people to actually be more proactive. We have 12 months in the year. We don't need to wait until the last week before
Yeah.
your taxes are due, whether it's March, April, September, or October 15th. Try to give yourself at least 3 months in advance to plan, implement, and make sure you're set up for success.
Yep. And I always tell people, think about tax in a 3-year period instead of just annually, right? Because if you think about it, we have some things that we can do to amend prior tax returns to save money, but then also think about next year. What kind of changes are you anticipating? All those kind of things, because that's what we need from a tax planning perspective, because then we can kind of accommodate, right, the tax planning to your necessities and your goals. So that's why I'm always saying that. But that's why we're here. This is what the CPA revolution is all about.
We are about to get salty, right?
Ooh, yeah, things are gonna get salty.
All right. So business owners don't just hate taxes, they hate the gotcha rules. The ones that sneak up months later and turn what looked like a win into a painful surprise. The new
Yeah,
$40,000 salt cap has stealth face out hiding inside it. And I would love to hear more about what you have to share, what you have learned in the past couple months, and how we can be proactive and be prepared to take advantage of the benefits and not get a surprise at the end.
yeah, everybody hates that. And we kind of go through these things right about now, right? When people are
Mhm.
filing their tax returns and they're like, well, my accountant said, and all this other stuff. Every year we get those kind of clients. And that's the thing. It's like you want to be proactive, and here's why. It's because of these kind of things. So there's this 40K salt deduction that everybody was so happy about, right? Yeah,
Mhm.
it went up from 10K to 40, everybody's happy. But then you start realizing, if you're a high earner,
Mhm.
and what I'm saying is 500K or above in this instance, then you have to start thinking about, well, wait a minute, it's not 40K for me. It actually starts phasing down. So 30 cents on the dollar is lost, right, after 500K. So you completely lose your salt deduction, and it's going to go back down to 10K at 600K. So
Mhm.
these are the kind of things that you want to know about, right? And anticipation, and kind of understand them before, so you can plan around. That's the thing about tax planning. It's not a one-time thing. It's
Yeah.
continuously evaluating everything. So yeah, that's the thing about the salt. So why
So
does
the
it
way
bite?
that I
Mhm.
understand it, Jose, it's more
Yep.
like if your income falls between like 500 and $600,000, you're walking straight into what most people call the salt cliff, right?
That's right. Yeah, it's a big phase down. It's a phase down, and it's like I said, for in this instance, for high earners, you kind of wind up losing out if you don't know how to, or you don't have a good tax planning attorney, a CPA or whatnot. So yeah, kind of things that you want to know about.
So, what changed and why does it bite? Tell us more about that.
Well, it's 40,000. So the sell cap is $40,000, and that's true, right? Up to a certain amount. So once you start going over that 500K, like I was telling you, it's basically 30 cents on the dollar that you're losing per deduction. So it completely phases out at 600K.
Mhm.
Totally gone. The other thing is that this is only good through 2030. So it's a temporary thing. This is not a permanent change. So, you're going to lose this if you're already losing, or if you're already making enough money where you're losing it, then, it's going to go back down to 10K in 2030 any which way. But for the time being, you want to make sure that you're taking advantage of, the strategies that are out there for this.
Yeah, for sure, for sure. So why these, being unprepared is it's one of like the pitfalls for it. How
Yeah.
can we plan? Like what are your some of the advice that you can share for people to look out for?
Yeah, and that's one of the things that I mentioned in this week's article is, you have to prepare, right? You have to. It punishes bad timing. So that means anybody who's waiting until the end of the year to kind of like even look around for this is going to obviously be at a disadvantage. But not only that, we're going to use a little example in a minute here. If you don't know about it, right? So maybe you just get this big raise or this big Christmas bonus or whatnot at the end of the year that just edges you over and you lose it.
Right.
So those are the kind of things that you want to be aware of. It's one of those things like it's the classic, I thought we were going to be fine this year with taxes kind of thing because you're not planning around it, right? And we talk a lot about those things, the excess business, loss limitations and all that kind of stuff. So this falls right there with those kind of issues.
Right. So how do we plan, at least how can CPAs that have that strategic mindset start planning around this?
Exactly. So you have to basically work with the client strategically every quarter, like we do, because it's critical. You need to kind of anticipate what's going to happen. Talk to your client, let your client bring in his recent financials or whatnot. Talk about what kind of changes are going on in his life and so forth. Getting in deep so that way we can kind of figure out, hey, do we need to adjust things for the next year? So there's some other things that we're going to talk about in a minute that we can do to perhaps help mitigate this issue. So that's coming up soon.
All about preparation and bringing those options to the table so
Yeah.
we can make the best decisions for ourselves as business owners and also for our clients who may be, going into this road of uncertainty, right? So
Right.
tell me a little bit about like what are some of the options that we have on the table right now?
Okay, the first one is timing your income. Maybe if you're getting that big bonus, right? Maybe you want to time that off, right? If possible, right? If you're going to land a big contract at the end of the year in your business, maybe you can just wait until the following year because then obviously the less money that you bring into that business, the less money is going to flow through if you're in this case of partnership or S corps or whatnot. So that's one thing. The other thing is front loading expenses, rent, certain kinds of expenses that you can prepay. Well, that's good, but obviously the IRS, they've been there before, they know what you're trying to do. So you want to be careful. You want to plan with your CPA, right? How to do it strategically so that you work within the bounds, right? And you don't raise a red flag.
And that only applies to cash basis only, right?
Well, no, that would apply. Well, yeah, for cash basis, it wouldn't necessarily apply because you recognize income when it's earned, right? Or when you receive it, I should say, versus invoice, right? That's recognized once you receive. And then, of course, you have the offset to accounts receivable, but it's still considered income in that period.
Okay. Accounting 101 for me.
Exactly. But here's a big thing. If you're a business owner, and depending on what state you live in, you can use this thing called pass-through entity tax. What it does is basically allows your business to pick up that deduction. So you can actually run SALT through your business, hence lowering your income for your business, right? And it flows through to your income, to your personal taxes. So that's available, right? Now, there's limits, there's rules, there's all kinds of things. So it's not like one of those things where I'm just going to go and, do what I got to do, find out just enough to get by. That's not going to be one of these kind of things. It all depends on your state. So you want to kind of talk about it. Different types of entities, the flow throughs qualify, C Corp, not necessarily. Although even maybe a C Corp, if by the way you were going to do it anyway, or you're in a C Corp anyway, that's something else that you can look at. So different things that you can apply it to, but you're going to work with somebody who kind of understands this thing and can explain it to you, right, in a way that you can understand it.
So what is PTET? Again, it's the pass-through entity tax. Can you kind of like break it down and give us some examples of how that all works so everyone understands what that really is and how they can learn more? And again, I always want to share the disclaimer: we're not giving advice in this channel. We want to make sure that we are talking about certain things that you should be discussing with your professional and licensed teams to make sure that they are working for you.
Right. So basically, what is it? So we kind of just mentioned it. It's something that you guys, it's just a play that you have if you're an S Corp owner, partnership owner, so forth. Anything that flows through to your personal, right? So basically, it lets your business pay your state income tax instead of you paying it personally. That's basically the main draw to this, right? So the business pays for it. It deducts that tax, right, on the return, which helps you get around the 40K SALT cap if you're over the 500K, right? And the phase out, like I said, is between 500 and 600K. So that means that less income is showing up on your personal return, and then you have less pain from that SALT cliff that we call it, right? That SALT cliff is at 500K. So now basically what happens after that is if you're going to be working with a CPA, you want to bring this to them. Obviously, you have to talk to them, see if they understand it, right? You have to make this election each year. So obviously that's something you want your CPA to understand and make sure that it's the right thing for you to do. So practical illustration. Let's talk a little bit about something that I included in this week's article, and I called it the January two-step, right? So basically what is it? Prospect reaches out like they all do December, right? 2024 or later. Right, and they show up with this $540,000 projected AGI, right, adjusted gross income, and a $120,000 project is set to close on December 28th, right before they head out for the holidays. So their CPA already had told them, hey, so it's 40K. So everybody's happy. They come to us, right? We run the numbers and we learned that that deal is going to cost them $36,000 of SALT deduction. 30% of the 120K that would put them over the limit. So that pushes their taxable income to $156,000. So now what do we do? This is one of those kind of things where we're like looking at the situations, asking questions. We can move that money forward, that contract, right? That income, that project, move that money forward to January 3rd. We can also, and we're talking about a business owner who's an S corporate partners, whatever it may be, increase their retirement contributions and then make some prepaids, maybe prepaid rent or whatnot, so that we can basically qualify to get that 40K SALT deduction. So with all that being said, what we do is we keep the SALT deduction, obviously, because we lowered the K1 that's flowing through the pass-through entity, and we cut the federal hit by 5 figures. So we actually save them 5 figures for that, using that strategy.
Very, very interesting. The way I understand that new SALT rule didn't really solve the problem, they disguised it, right? Am I following this correctly?
Yeah, it's one of those things that they gave out to kind of appease the masses, right? But the masses a lot of time don't read, the fine print on a lot of things, and this is what happens.
Yeah. So what I'm hearing is that your average CPA will tell you the SALT cap is 40,000 and that's the end of the story. But then a strategic CPA will forecast your income and then use PTED and time transactions so you don't donate your deductions to the IRS.
You said it fantastically.
Yeah. So because when you plan ahead, you don't just avoid that cliff that you called before, Jose.
Yeah.
You keep more of what you earn. And that's the difference between filing and truly strategizing. So
Exactly.
I love that. So Jose, tell me more of how we can reach you. I know your articles have been adding so much value to the community for business owners and also for CPAs who are looking to be that strategic partner for their clients and optimize their tax planning processes. Tell us a little more how we can engage with you and more of your time and ideas so we are actually being proactive and asking the right questions. Because at the end of the day, as business owners, that's what we like the most. It's like we don't know what questions to ask, right?
Right, exactly. So a lot of you guys are opening up your internet, going to Google and typing in CPA tax, whatever it may be, all that kind of stuff. I get it, right? That's what we're trained to do. That's what we know. But here's the thing. We have a blog. It's on Substack. It's totally free to the public, totally free. This is my gift to society, if you want to call it that, where you guys just provide articles. There's a chat. If you have any questions regarding the article, whatever it may be, you just basically write a question in the chat. That's all. So with each article, I try to also include some resources, when available or if it fits. And you guys get that totally free too. Now, the whole idea is you don't have to select me, but what I want to make you guys do is I want to give you guys I want to empower you guys so that when you go to those CPAs, you have some background, you have some knowledge, and you have some resources behind you, right? That's what this is all about, because too many of us lose way too much money in tax, right? Which impedes our business, if you think about it, right? Which when there's no money flowing, the society's not growing, it's not benefiting. So that's the thing. So that's the way you can reach me. Also, our website, thescalecollective.net is another way. But you'll get these articles in your inbox, so you don't have to do anything but just sign up and we'll go from there.
I love that. And we are all in this mission together to raise awareness and make sure that we are becoming better every day. So thank you for your time, Jose. I know you just went through a busy season and you should be vacationing right now, but we're just dropping these golden nuggets here to prepare everyone for end of year tax planning. So thank you again. And we look forward to seeing you on our next episode.
See you next time.